The Morgan Report with David Morgan. Discover how to build and protect your wealth at themorganreport.com.
Welcome, everyone. This is, as you know, David Morgan, themorganreport.com, and this is going to be my weekly perspective this week. A little different. It's a live interview. Well, I won't say live. It's a recorded interview with Bob Coleman, founder of Idaho Armored Vaults. And just for full disclosure, I store metal at Bob's facility and highly recommend it. So I'll leave it at that. Bob, we talked offline. We do probably once a week. You've got a lot of contacts. I have a lot of contacts when I compare notes with you. One of the main comparisons was, what's going on in the wholesale market, and how much real silver is out there in the retail side, even on the, not only in the wholesale market, but in the big inventories, what's in, the LBMA and the CME and that type of thing. So what we discussed very recently was this mint, quote unquote, closure. And I already had a strong idea about it, and you verified it. And this is the fact that we've minted, and I don't have the exact number. Last time I looked, I thought we were up to maybe 1 billion ounces of silver eagles. I was wrong. I think it was like 685 million, which is about 70% of 1 billion. That's a lot of silver eagles from 1986. So the point that we made was that the reason that the mint isn't producing silver eagles right now isn't because the demand is there. It's because the demand isn't there. And the reason for that is because all of these dealers are just locked up with inventory that they basically, I say, can't get rid of, but there's no real demand on it. Can you elaborate on that? And if I missed something, let me know.
Yeah, no, definitely. And it's always good to talk to you and your listeners and so forth. The issue we have with the U.S. Mint for new product, and this is very similar to the Royal Mint, the Royal Canadian Mint, a lot of the mints selling fresh, brand new product. The cost to buy that product is so much more expensive than the secondary product that's on the market right now. So wholesalers are really, this drumming that we've had in price here, I think, has unlocked finally a buying of metal. People are starting to get back into this a little bit, and that's kind of taken away some of the secondary inventory that's been sort of overhanging the market. But what's happened the last few months, really since the beginning of the year, has been really people selling back. IRA people selling back metals, worried about further decline in their retirement savings and so forth. There are a lot of people just concerned seeing things pulling back and getting scared. At the same time, you've had a lot of people that own silver and gold at much lower prices, and they're just taking profits on a portion of their metals. Well, that metal that is being overwhelmed, sort of the dealer industry, and what the dealer industry did in reaction to that was said, listen, I have enough secondary product that I can make a market and just move the premiums and discounts around based on demand and supply just on the secondary product without having me to go buy brand new product, because there isn't enough overall demand for brand new product. And this is why the U.S. Mint, along with other mints, have just seen an absolute bleeding of product being bought from them. And that's basically the simplest answer, I guess, you could come up with.
Well, it's very direct. It's Occam's razor. And what I would also say or ask is that why would they deploy new capital as an authorized participant when they're sitting on a bunch of inventory that's cost them capital, correct?
Yes. And not only that, I mean, you see it with some of the wholesaler pricing. A lot of these guys are literally trying to give brand new product away. I mean, literally just cents above on a per ounce basis, cents above where they're buying it, just to try to unload it, to keep that relationship or partnership with that mint or refiner sort of open, that you're constantly still buying some product from them. But yeah, it's been a very difficult situation. I think that's one of the reasons why retail dealers have widened spreads to an nth degree, which is very unfortunate, to say the least. But they're not seeing the transactional business that they were seeing in the past. So the only way to make that up is, hey, let's just widen the spreads and make more money off the guy who's selling, with the idea that we're never going to see them again, and we'll try to resell that metal on the fly back to another person. Now, with the market melting down like we've had and this big rush to the downside, what's happened is if you're hedged correctly, you're not going to be impacted as a dealer. But there are dealers that don't hedge, and even with these big discounts that they're buying back metals at, you've had such a big price drop. A lot of these guys could be underwater at this point, and that becomes an issue as well. But what you're seeing right now with a lot of big online dealers, you're seeing $8 to $15 under spot for almost any silver product out there. That disincentivizes the consumer from wanting to add to their portfolio or use physical metal as a store of value. And that's one of the other industry problems right now.
Yeah, just to put a point on that, I mean, I've been, looking at the metal since I was a kid, really. And up until the last 3-4 years, I think around the time of the illness, where we really got these bizarre widespreads. I mean, I actually put on my Twitter account a week ago or so. I mean, you could always get spot or near spot. I mean, I remember my first 100-ounce silver bar was not a JM. It wasn't Eagle It was a soft pour off of a nobody. And I had to take a slight discount, and I forget what it was. I mean, silver was, $14 at the time, and it dropped to 10 or something. But regardless, it's only been in recent times, and you've been in the industry long enough to know that. Do you think we're going to get back to what I would call a reasonable market where people can be pretty much assured that they're able to sell back near spot?
You really have to, the industry has to curtail its practices for that to happen. There just is no incentive because there's no regulation. There's no oversight. No one wants to take the step in trying to kill their profit margins to better the next guy. If APMEX or JM Bullion or some of these other ones are leading the charge, or they're known as the 800-pound gorilla, and they're charging $12 over spot for Silver Eagles, well, what incentive does someone else have to say, well, I'll beat that, but I'll beat it by maybe 50 cents an ounce, just to make myself look better, but I can still make a killing. I think the industry has gotten used to these high premiums and these wide spreads, and they've grown their businesses, or they have employees, or they have overhead. They may have borrowing costs and costs of carry to maintain their inventory and so forth. The shipping, all these types of things, these costs get funneled into it, and maybe they built a model that needs an X profit margin, and they just can't afford to go below that, which is unfortunate because obviously it ends up the consumer pays a dear fortune for something that they're trying to protect their purchasing power with. But what they end up doing is giving all their purchasing power to the dealer, and that's unfortunate.
Very. I want to, for the record, I mean, I did it with the Mint, and I did it with Tom Powers, who's the CEO of Sunshine Mint, close to me. But when we had these huge premiums, not right now, but back when there was a big rush towards silver, and everybody's buying Eagles, and the spread was, I think I saw $14, $18 at the times. And for the record, Bob, it wasn't the Mint that was putting on those big premiums. It was the dealers, correct? From my understanding, from Tom Powers and the Mint itself, they still gave the normal spread that they have, which does vary, but slightly, somewhere like the 365 per coin or somewhere along those lines. Don't quote the exact number, but I'm giving the correct idea. So people were blaming the Mint for, gouging the public, but it was not the Mint, correct?
Correct. It was a multitude of issues going on at the same time. You had the Mint not making enough product because they had made a lot more product in the 2010s than they did in 2020s. So what ended up happening was there was a decline in productivity, which in turn you combine that with the Russia metal, people buying metal, and what happened was the wholesalers started lifting prices, but the wholesale pricing was somewhat. If they lifted the offer, they were also lifting the bid. So if you were selling, you could get a lot more money for your metal. But what the retailer dealer was doing was lifting the offer big time. I mean, they went to $20 over spot. and maybe they were paying $6 over spot or $8 over spot, but knowing the retail dealers were playing this game.
Sorry to interrupt, but the $6, $8 they're paying over spot were to other retail investors, not from the mint.
Correct. Yes. And what they were doing was, at the time between 2020 and 2023, if you took 10 transactions, 9 of them were purchases, maybe one guy was selling back. So you turned into this game of what they called ghost bids, meaning they would show a big bid, for example, to support that even bigger offer price, but knowing that 9 of the 10 transactions were going to buy, not sell. And so you had that game going on at the same time. So what ended up happening was COMEX, for example, authorized participant for the U.S. Mint. They were buying Silver Eagles in 2020, 2022, whatever it may be. At the time, it was $2.95 over spot, and they were selling them for $20 over spot, making a fortune. And what if that was, whether or not that's right, that's another question, but that's what was going on. And what ended up happening was the premiums got pushed so high on the Silver Eagles. The bright idea of the industry said, listen, we can actually create more profit margin by buying and making silver rounds and proprietary private labeled silver bars. And because the mint, the Eagle price is so high, because everyone kind of looks at the Silver Eagles as the preeminent product out there. Well, if that premium is so high, we can get even more money for our rounds, just because it makes it look like they're saving money. And so the industry made, I would say, billions of dollars, if not hundreds of millions of dollars, on this business model, which fleeced the public. And the Wall Street silver movement, a lot of these big celebrity dealers that we see in the market today made a fortune off of this business model. And now people, luckily, the price of metals went up 5-fold, but a lot of people have not made that kind of money because they overpaid for the premium to begin with. And that now you're starting to see the fallout, because now the discounts are coming into the market where people are getting $6 under spot for Silver Eagles, or they're getting $10 or $12 or $15 under spot for any other 3-9 fine product. I mean, it's to a point now where silver maples, a lot of big online dealers are paying $10 under spot for silver maples, which that was being sold for $8 to $12 over spot, I think, currently right now.
I don't want to beat a dead horse. I have one more comment. I want to move to a different topic, but it's my strong opinion, and I don't have anecdotal evidence. I mean, I have a fairly strong paid subscriber base and obviously a fairly strong following, but I don't have a lot of people that have, called me, talked to me, written me, but a few. I think this has really disrupted the faith in the market, because if you've paid 18 over and you're getting 10 under, it's like, I don't want to deal with these silver people or gold coin dealers anymore. I feel like I've been had. Do you have more verification of that?
Oh, I'm getting calls weekly from people that bought from these white knight gold dealers, that are promoted on YouTube, or they have, a prominence of social media exposure all over the place. You get on your YouTube account to watch a video, and then all of a sudden you see all these ads pop up for gold dealers, and they're all A+, triple B rated, or Better Business Bureau A+ rated dealers. And that model there's a lot of misinformation, unfortunately, that we could go through and kind of share. But no, you're absolutely right. The market has shifted, unfortunately, to say, listen, maybe I should just buy an ETF if I want exposure to the silver market, because I can get in and out. My costs are almost nil. And the way the volatility is, it's scaring me. If we get a big run up, maybe I should be taking it, because I don't know if this thing's going to come crashing right back down. And so that's creating this uncertainty, unfortunately. And at the same time, you have the stock market hitting all-time new highs, AI, all these reasons to be somewhat, even though we're maybe concerned about the price of the stock market and so forth, it's not crashing. And so the narrative that the market's going to crash and the bond market's going to crash and all these things are going to fail never came to fruition either. So it makes it either more inviting to say, listen, maybe this is just a trade after all. It's not necessarily, the long-term investment I thought it was. And if it's not worth paying up the kind of premiums these dealers are wanting for this product.
Yeah. Okay. Well, I want to move on to another topic. I'm going to share my screen here and get to the right window. And Bob, if I have got the wrong thing on there, I got to look for this thing now. I've got so many windows open. There we go. Share. So one of the most important things, I think, as far as, how tight is the market. Now, I define the silver market as a commercial bar market. Why? Because it's a bid-ask spread based on a derivative called a futures contract. And that sets the price pretty much worldwide. Of course, there is also the LBMA and there's also the Shanghai Exchange. I know all of that. But basically, the COMEX is kind of the king of the hill. And that's where most of the prices are set. So based on that, one of the things you'd want to look at as far as true tightness in the commercial bar market, because the retail market is really a subset of the silver market. Not that it's not important, but if you really want to find out what's going on with silver, you've got to think in terms of commercial bars. So right now, what I'm showing on the screen here is the COMEX itself. And if you see here, this warehouse and deposit stocks, if you click that, you'll get an Excel file and you will see what the amount of silver is at any given time. So I'm bringing that up right now, and hopefully, Bob, you're still seeing my screen.
Yeah, I can see it.
So now, right now, what I want to show with the cursor here is the bottom here. Now, on the left are all the different depositories, Ashanti, Brinks, Delaware. I won't read them all off to you. But the bottom here is how much registered, how much eligible, and add those two together for a total. So right now, we all can read, I'm not going to read the all exact number, but 87 million registered, 236 million eligible.
Yeah. Do you have that up right now? Because I don't see it on.
Oh, that's why I wanted you to.
Okay. Yeah, I see the delivery notices section.
Let's see here.
And I think for your listeners, to try to educate them a little bit more, there's a difference between delivery notices and stocks, the physical stocks in the warehouse. Those are two separate reports. And I think it's important because this is where the gold dealer industry uses manipulation to get people completely confused on what each report actually shows or provides in terms of data. So what you're pulling up is what they call the stock report, which tells you how much metal is in either the eligible or registered category. And the registered category is the one that backs the actual futures contract. The eligible category is the one that says, okay, these are 1,000-ounce bars that can be put onto or on receipt and be good delivery for a futures contract. But currently, they're just sitting in a private account within that COMEX depository. Whereas the delivery notices report, which is what a lot of dealers try to use as hey, listen, there are all these deliveries going on all over the place. That is simply the change of warrants changing hands. It's like the stock market trading back and forth. It's just going from a bank or from a clearing firm to another clearing firm. It doesn't mean that metal is leaving. It's just that someone is using maybe that collateral or needs that collateral, or they want some kind of exposure or some kind of hedge.
Yeah, I've gone through that so many times, and yet it doesn't seem to be clear to some people because, to be a good analyst and look at, how tight is the silver market, you want to check this report. And you look at these boxes here, and you can do that. If I was running a dealership or something, and I was always talking about the silver market and gold market and how much inventory there is, I would have one of my staff members do this Excel file and give it to me every 2 weeks. That's all you have to do. And as far as what you outlined is exactly right. So let me go to another tab here, and I'm probably going to have to reshare because I'm kind of catching on to this.
Before you do that, if you could scroll up on this, There's if you go to Asahi, for example, and you see that 602,815 ounces delivered into the eligible category,
Right.
that basically what that represents is a truckload, what we call in the industry, of silver. So it's what roughly about 600,000 ounces will be transported in a shipping container. That's what that is. So when you see these big numbers come across, that's just a standard delivery. Even though it's big, that's how it typically comes in. So it gives your listeners maybe a little bit more color on what these large amounts are. That's what you're typically seeing. So, for example, that when they adjusted the registered category in that same Asahi depository, someone took moved metal 648,000 ounces from the registered category to the eligible. That was probably a complete shipping container of silver that had come in, and it's basically being moved all in one unit.
Very good. Thank you for that, Bob. So this is a pretty good website here. This shows the total inventory. This is for the LBMA, and you can see this goes back to the year 2017, and you can see in 2022 we had this big offtake, as we know. And then in 2025, in January, early 2025, huge amount left the LBMA. And then it kind of came right back up to where it was back here in, let's say, the middle or fall of 2023. So this is also a website that people can use to get a better idea of what's going on in the, sorry, I'm scrolling fast, to the actual physical market, without maybe understanding the warrant process that you outlined so well. And I obviously haven't done as good a job, let's say, as I'd like to, because I think there's some misrepresentation as far as how much silver and gold is actually coming in and out of the exchange. But this gives it, on a bar graph. And again, I think that curve I showed a minute ago is probably one of the better ones. So on this website, they have a lot of interesting things that you can look at. You look at the inventory, which we just did, and I think you can get to, I know you can get to the COMEX because it was on there last night. And I don't want to waste your time while I'm trying to remember what I did 24 hours. There we go, COMEX silver. I think that'll bring it up. So here's the COMEX from 2024 to present. And if you're honest with yourself and you actually look at the God honest numbers and you look back at 2024, this is registered only. I'm sorry. So let me get to registered, eligible, and total. All right. Now we're talking the whole thing. So if you go back to 2024, there's the total. It breaks it out. So the total is 274 million. You come over here to the latest and you get the total here, if I can get it to display correctly, and the total is 323. So basically it's higher today total than it was in 2024. So it's not being drained. Now, this part here, this big move up, was basically, most believe due to this fear of a tariff coming on and it would cost more to import because you're going to have to pay more. Well, you're going to get ahead of the game and you're going to bring it in. Now, other people disagree with that. That's fine. It's again, Occam's razor makes the most sense because that's a huge increase, Bob. We both know that. Flattened out, the tariff didn't happen, and a lot went back in the LBMA, as I showed in that last chart. The other thing that's on here is how much, silver there is coverage-wise, or let's say leverage-wise. So right now there's 6 times more paper than deliverable metal. But constantly we hear 100 times, 300 times, infinite times. It's so ridiculous. I'm going to pause because I'm starting to get wound up. Bob, can you go through the reality here that we both know that seems as so many that are in the industry, let's say maybe a little more salesy than you and I purport?
Yeah, it's very frustrating. It's something that for years I've been talking about, this idea of, back in 2011, yes, there was a point where there was about 100x paper ratio to the registered category. And that was mainly because I think inventory levels were a lot lower then, and there was a lot more participation in the futures market. Well, some say, well, there was a lot more participation because the price was 5x lower. You're talking silver at $10 an ounce or $15 an ounce. A lot more people can participate with leverage than they could at $50 or $100 an ounce. So you have that natural decline in open interest because it's just a lot more expensive contract. That was one reason. But as 2014, 15, 16, 17 started to come into the picture, and in 2018, 19, you started to see inventory coming in because it wasn't being bought by the public. You started to see inventory levels build up. And then with COVID and so forth, you had higher elevated inventories, and you didn't have as much in terms of open interest. So that brought that ratio down into that single digits. And it's unfortunate that dealers out there promoting the idea that we're over levered, the COMEX is going to fail, the LBMA is going to fail because of all this leverage. It's very disingenuous, and I think it's where the core of the manipulation of this market kind of lies, is with that type of promotional type of clickbait marketing. But this chart actually really dispels that very well, because it kind of shows that, hey, this takes the registered category, divides it by the open interest, and that open interest is basically outstanding futures contracts that are trading off of whatever's that registered inventory is representing, or basically the physical metal that's being used as collateral for all these paper contracts. And you can see that it's not at 100x, and that's unfortunate.
Yeah, you said something. I'm going to back you up a minute. I'm not sure I heard it correctly, so I'm going to have you redefine it. But you talked about manipulation a minute ago, but it sounded as if it was more of a manipulation on the sales side by touting 100 times, 300 times, the banks are going to blow up. I don't know how many times I've heard that this next delivery month, the banks are going to blow up. Yes. I mean, it just drives me nuts. And yet, if all these people have all this control all the time over the silver market, totally manipulating, and then when it gets to the end of the month, those people don't have any control whatsoever at all. Can you explain that? But before you do, what did you mean by manipulation? Were you inferring that maybe people are manipulating the cognitive ability of the newcomers to the metals market, that, oh my God, it's so leveraged, I can only win?
Yeah, dealers, promoters, substackers, a lot of people that pride themselves on subscription type models, where they need to breed some type of fear or some type of sensationalism to build up their subscriber base or maintain their subscriber base. Well, you have to come up with all these reasonings, I guess, for people to want to keep reading the garbage they put out. That's unfortunate, and that's where the manipulation comes in. These dealers work in tandem with a lot of these guys in the industry that promote a lot of this garbage. And unfortunately, the dealers use that as a battle cry to say, listen, it's us versus them. And at the same time, buy the metal from us because there's a shortage, or you're not going to be able to find this stuff, or we're the only ones that have it, or we have a great price. But in essence, what they do is they artificially mark up the metal even higher because they have to pay the affiliate fees, or maybe the partnership with the guy that is promoting. You may have the newsletter writer who's promoting, or as an affiliate, a certain dealer. So anyone who buys metals gets some sort of cut. Or you see that with the promoters or the YouTubers or the social influencers. I mean, it's a very common model, but with these dealers that heavily market the stuff to a certain demographic, it's not necessarily, hey, listen, everyone has to make money. I totally get it. Everyone has to be paid for their time. But in this instance, it's a fear-mongering type mentality to drive anxiety and fear into the buyer, to get them off the couch, to buy the metal, not think about the premium, but just say, hey, listen, If this thing's going to go to $200 or $500 an ounce silver, what do I care what I pay for it? I'm going to make a fortune off this stuff. And that has been sort of the mantra since COVID. People talking about $25,000 an ounce for gold and those types of things. Well, maybe one day it hits that, but the question is, people are paying exorbitant premiums to put their money into a product that they don't know what they're going to get when they blow it out. I mean, you saw silver was $112 an ounce, for example. I've had people call me up selling when they were selling to other dealers out there. They were getting $16, $20, $25, $30 under spot. Even at some point, some of them were getting 60% of the silver price when they went to sell back. They weren't getting paid nearly what the spot price was showing, but at the same time, these dealers will say to their YouTube viewers or listeners and say, listen, the Shanghai price is really the real price, and it's $10 higher than the COMEX price. And see, look at the manipulation the COMEX doing. But when you go to sell the product back to the dealer, he's giving you $10 under the COMEX price. So it's a round robin that's, I think, creating this distrust, and consumers are just lost because they're trying to find, listen, I need to build a relationship with someone that's not going to screw me over, in essence. And that's the unfortunate part.
And I interjected there on the manipulation word. You were going somewhere else. You remember where it was?
On the manipulation side, I think it's more, there's more manipulation. Yes, the whole system is manipulated. I completely agree with that statement. We live in a world kind of like the Matrix where, listen, the U.S. government wants to maintain dominancy using the global reserve. U.S. dollar is the global reserve. It provides so much advantages. It allows them to create more debt, and then we borrow that debt or lend that debt into existence. That's how we were able to maintain our lifestyle and so forth. Yes, that is national security, basically. So understanding that, yes, every market is going to be managed. I totally agree with that, and our market is no different. It's just learning how that management and how that control or how that dynamic influences the short term as well as the long term. I know you've, David, said this a long time. The market ultimately wins out. You can maybe manipulate things on a short term basis with short term price action or trading and so forth, but on the long term, the price of gold has been one of the best performing assets since 2000.
Right, exactly. Well, I've certainly you've been generous with your time. I have nothing to add. I covered what I wanted to. I wanted to dispel some of these ideas about, the war in exchange and really the deliveries. Oh, I know what it was. The last one was these people that manipulate the market, talking from the main manipulation, the controllers, they've got everything wired until it's the end of the month. And then those same people are going to lose control. Could you comment on that, on these delivery months?
Yeah, I'll kind of explain, and you've probably done this for your listeners as well.
You might do a better job because obviously I'm not getting through to very many people.
Yeah, so basically, most of the time, the futures market is a hedge against an underlying physical position, whether that physical position is in New York in a COMEX facility or that physical position is in London or someplace else. Participants or clearing members will use futures contracts to hedge the price action, or they'll use it to capitalize on the basis point trade advantage. So when you sell a futures contract 3 months out, for example, or 2 months out, typically you get a little bit higher price than you do for the current spot price. That's what they call contango, meaning that future price of silver includes, maybe the cost of storage and cost of financing, that type of thing. So a lot of players make money using that. They similar to sticking money in a money market fund earning 4%. It's a very similar return of say just simply taking a bar of silver, putting it onto the exchange and selling a futures contract, and then that futures contract eventually loses all that premium as it gets closer to maturity. And so what they do is, yes, they're short the paper, But when we get close to that delivery month, they don't want to give up their metal. What they're doing is that then they're buying back that contract and then selling the next futures contract, say 2 months or 3 months out, whatever the next lead month contract is. And it's just for them, it's a process. That's all it is. Now, what happened in the last couple of years that disrupted this process is that you had this fear of tariffs that said, listen, I have this metal that I'm holding, say, for example, in London, that I'm using the New York futures markets to hedge with. And this is what this exchange for physical premium kind of explain. It kind of identifies. It's the London price compared to the New York futures price. So what ends up happening is, in a tariff situation, if I'm short futures and I'm long my physical, yes, it's a balanced trade. But if I have to get that metal from London to New York to settle the trade, and all of a sudden there's a 20% tariff put on it, all of a sudden that's a 20% increase in expenses that I cannot account for. So I end up losing money. So for example, if you're $1 million long in physical in London and you're $1 million short in New York, for example, or $1,020,000 in New York, so you're making a $20,000 return. And all of a sudden you have to bring that metal in. That 20% of 1 million is $200,000. That would be your cost to bring that into the US. That panic is what shifted a lot of metal into New York. It brought a lot of metal, not only silver, it brought platinum, it brought palladium, it brought gold. And so you had this massive influx. And the biggest buyers of metal during 2020, 24, 25, and so forth were the banks, because they were buying physical and they were selling at the time. The premium in New York, the futures premium went to a very fat contango, meaning the price went artificially very, very high. And so it gave a great incentive for a bank to buy physical and deliver that and sell a futures contract against it, because it wasn't just simply, say, a 50-cent spread between physical and the futures. It was maybe $1.20. So it made more sense to do that. And that's a guaranteed return because they're hedged on the price. That's why you had so much metal come in. And that's why the banks were the biggest buyers of metal. Unlike what a lot of these dealers, which promoted the idea that the banks were manipulating the price down, the banks were actually the ones making the most money and supporting the market, especially the physical market, but buying so much of it. And that's really what kind of happened between 2024, 2025, and so forth.
Very good. Well, I want to close out, Bob, before we leave. Why don't you let people know where they can learn more about you? I know you're on X quite a bit. I follow you there, and I think a lot of people should. And I'd like to add another comment. I will, but I might just go on deaf ears. That, you got to be careful of where you get your information. And I showed you the COMEX. That's the information that you can rely on, not necessarily someone that's sending out the first notice days or first notice deliveries or quote unquote deliveries. Yeah, they might cut and paste the screen, but that's not a true delivery coming out of the exchange. Anyway, Bob, I'll give it back to you. How do people learn more about you?
Yeah, I'm on our website is goldsilvervault.com. We have a lot of information there. We have articles, interviews, and so forth that we put up as well. But yeah, you're right. On X, Profits Plus ID, as in Idaho, is also, that's my account. So I try to put out information is there as well. And
just on that, then we'll close the recording here. But how has your growth been on X? Because I've been watching you for years, and it looks like you're getting more and more people that finally find you. Is that true?
Yeah, it's been a tough go because I'm not a hypester. I'm not one that lives off of sensationalism and clickbait. I try to stick with facts, try to be much more educative rather than salesy on social media. And I think that's, unfortunately, the guy with the biggest bullhorn that tells, that maybe is the biggest cheerleader tends to get a lot more followers. But at the same time, they usually put out a lot crappier information or information that just is not actionable. But in this day and age, a lot of people sort of like to be catered to, I guess, or they like the bias confirmation, and they want to be fed that kind of line of, hey, listen, this thing is going to continually go up forever, or we have great prices on things, and unfortunately, that's what is sort of dominates the social media scene. I'm hoping to change that, but by staying consistent, I think the followers that do listen to me, I have a lot of respect for them. They have a lot of respect for me. They know that there's a degree of professionalism that I bring to the table that they can kind of depend on. That, hey, if they need to get the right answer, I'm willing to do the research and then post something that actually has some factual meaning behind it.
Very good, Bob. Well, thank you so much, and I will revisit you maybe in another month or two. Definitely worth our time. I appreciate it.
The U.S. government debt is about to cross $37 trillion. That's not a typo. That's trillion with a T. Tariffs are being used to try and even the playing fields. Global supply chains are shifting. Inflation isn't going away. And the value of your dollar? It's quietly being drained while no one is really talking about this. The truth is, we're living through the early stages of a financial reset, whether anyone wants to admit it or not. And if you're still relying on mainstream headlines or financial advisors who just tell you to write it out, you could be blindsided when things really shift. That's where the Morgan Report comes in. For over 25 years, David Morgan has been helping investors cut through the noise. He tracks what actually drives markets, from precious metals and mining stocks to global debt and monetary policy, and show you how to protect and grow your wealth when the system is under stress. This isn't just about gold and silver. It's about having a clear-eyed view of where things are headed and making sure you're not caught off guard. The Morgan Report gives you real research, honest analysis, and strategies you can act on, even in a world of rising debt, unstable currencies, and economic uncertainty. Go to themorganreport.com today, download your free report, get informed, get ahead, and take back control of your financial future. Themorganreport.com, because $37 trillion in debt won't fix itself.